Well, we're back in no man's land when it comes to data because everybody's waiting for actual data the market might respond to. But what we're really responding to is Myron freaking out, now calling for even more rapid cuts, Waller confirming the October cut, while at the same time, we've got business surveys that are saying we've got issues. And Citadel, the glorious suits, are having a party. Now, why do you think Citadel's having a party? Well, folks, it has everything to do with a little bit of basic fundamental analysis at Robinhood. If you ever do any kind of fundamental analysis at Robinhood, you'll find that the most profitable portion of the Vlad business is options trading. So they make so much money off of you. They love your options trading, and who provides the rebates? None other than your homies over at Citadel, your favorite Ken Griffin suits who love GameStop. Oh, wait, I read that backwards. But anyway, Friday, October 10th, listen to some of these stats. Friday, October 10th marked the largest options trading day in market history. Never before, nobody knows options trading quite like Citadel, and never before has the market seen 108 million option contracts traded in one day on October 10th. That was when we had the Binance scam rug pull. I mean, that's just an opinion, don't sue me, bro. The crypto shocker that nobody could have seen coming. There was absolutely nobody could have seen the crypto scam coming. Because after all, we have the Security and Exchange Commission that watches what's happening, right? Oh, wait. SEC, October 1st, announces that until further notice, the agency will have very limited number of staff available. And then in, just the 9 days thereafter, we get a $19 billion rug pull. Would be crazy if some whales happen to time some insider trades just, minutes before such announcement that would end up minting those whales hundreds of millions of dollars. That'd be crazy. But anyway, so largest amount of options ever traded in market history. This is the second time ever that we've crossed 100 million option contracts. The first time being on Liberation Day, which is wild, where we first topped 100 million option contracts traded. Option-wide flows are currently exceptionally high, with Friday's surge epitomizing the buy-the-dip mentality. So institutions are hedging, but retail is going absolutely ape SH9T for options and stocks. Retail is like, bro, I'm all in, shove it up the butt even more, go deeper, baby, I want more. More margin, more contracts, more ETF, more everything. ETF flows have, by the way, been positive for, I want to say, 205 out of the last 207 days. And even though you get institutions that are degrossing, retail is not. Retail is legit all in on this. And I wrote over here that the value of equities held by the final 50% of households increased by, 542% since 2020. I wrote this little red mark here. I said, if the stock market crashes, we's screwed. So we really cannot afford a stock market crash at this point. Now, are we going to get like a really bearish scenario 4 where we get some kind of, long and highly aggressive fight against China? Probably not. I don't think that Trump or Besson are going to go for this. I think we're more likely to be in like a scenario 3 or 2, which is where you get these little tit for tat retaliations and the trade war just goes on for like years. This is exactly what happened in 2018. And it led to a lot of uncertainty in 2018. It actually led to a bond market crisis at the end of 2018 that led to the Fed bailing out markets by promising not to raise rates anymore. We went all the way up to a rich 2.5% on yields, or rates rather, the FOMC rate. Which then begs the question of like, well, what did the Fed tell us this morning? Because, it kind of matters what the Fed and Myron and some of these knuckleheads are saying. As much as we don't really want to have to pay attention to it, it matters. So Myron this morning said that 25 basis point cuts are too slow to save the economy, which isn't great. So Myron is here advocating that we should really, like as soon as possible, be cutting more. This makes me nervous. Now, I mean, you already know that we actually made a little chart here on, if you go to, this isn't a pitch, meetkevin.com/data. So if you go here below the pitch, you see this little chart I put bear or bull scale, right? I still want to adjust this a little bit to actually make this slightly more to the left here, but I put myself at 4.3 out of 10, and people are like, man, Kevin, why are you not more bullish? Like the Fed cutting. Even Paul Tudor Jones this morning, he's like, corporations don't have massive debt yet, and the Fed's cutting, rates are gonna be lower, so, stocks are gonna be higher. And it's like, yeah, that is like the most basic analysis that you could possibly do on the market right now. Oh, the Fed's cutting, that must be a good thing, right? Not necessarily. See, typically, the Federal Reserve cuts going into recessions. The Federal Reserve panics when they realize the cuts don't do anything. And it's when they turn the money printer back on and they actually, we just turned off the vacuum cleaner. Okay, we were just vacuuming up money. We're just announcing that we're getting ready to turn off the vacuum cleaner. Technically, the vacuum cleaner is actually still running. So we're just barely getting ready to turn off the vacuum cleaner. Okay, the markets don't bottom until the Federal Reserve panics so much that they're printing like crazy. So this idea that people are like, oh, the market's gonna go up because the Fed's cutting, it's just not historically how it works, especially since there are long and variable lags between when, cuts happen and when the markets actually see that. But anyway, it's one of the reasons I've been kind of stuck in this midpoint, because I think Myron's onto something. And the fact that today he's like, dude, 25's too slow, man. Waller did tell us this morning that we are going to get, in his opinion, the 25 basis point cut in October, which is basically a foregone conclusion anyway. The market's pricing in like a 98% chance that we're going to get a cut in October and like a 97% chance we're going to get a cut in December. We're going to get our 2 extra cuts, right? So this is fair. We see this. So while Waller can't confirm it, it's pretty dang likely we're going to get that extra 25. Myron's pushing for 50. We're not going to get that. Why is he pushing for 50? Because frankly, even Waller reiterated what Myron's worried about, which is jobs are going to get cut because of artificial intelligence. We know that. The problem is the lag between when people lose their jobs and when people get jobs because of new opportunities that come out of AI. Nobody knows. Waller thinks it'll be over 2 years. So in other words, Waller thinks we're going to go from job losses now to maybe in 2 years we'll actually see jobs come back. Nestle's cutting off 15%, or they're cutting 15% of their staff, like 16,000 people or whatever. Actually, I think that's closer to 17% or 7% of their staff. Sorry, I think I screwed that off. I think they're laying off about 15 to 16,000 people, and it works out to about 7% of their staff because they've got over 200,000 employees. So that makes more sense. But anyway, they're cutting a bunch of their staff, and the CEO is literally saying the world is changing. In other words, it's just a euphemism for AI is taking your routine, boring office job. I mean, I see that, like I've mentioned it before. We see it at HouseHack too. At HouseHack, we're like, bro, we could do so much more with fewer people now. It's amazing. But anyway, Amazon, 15% of HR staff just announced that they're getting laid off. That's big. Waller sees rates 100 to 125 basis points lower. He's trying to confirm the October cut. Obviously, he doesn't have the power to confirm it, but he's trying to. And I wrote this all on the October business manufacturing survey that came out this morning, which suggests that current activity fell significantly and turned negative, more than offsetting last month's increase. This is the Philly Fed index. And while the new orders index rose, we did see employment tick down. So not a great read from the Philadelphia Fed. Definitely came in below expectations. Another one that came in below expectations was the New York Fed survey, where they say that business activity declined substantially in the region in October. Now we have to be careful, like these surveys can be volatile, but on a month-over-month basis, but it's worth reading this. The survey's headline business index fell to a multi-year low. Business climate remained worse than normal. So, this is why I think the Fed is starting to wake up and go, crap, man, we need to stop being neutral. We need to prepare. That's what keeps me nervous about debt. And this is I don't want to sound redundant. I really want to hit the news and stuff here, but I don't want to sound redundant. But there is a real opportunity to look at your situation and say, are you ready to pay your tax bill that's coming up this year? Whether you pay your taxes quarterly, April 15th is coming up, or in April, are you ready to pay off those buy now, pay later debts? Are you going to survive a larger downturn? You don't want to get caught with your pants down or, with no pants on. Anyway, so just to keep that in mind, I send out little notes like this totally for free, by the way, in the Meet Kevin app. If you download the Meet Kevin app and you get you go to the daily wealth tab, I send little productivity and happiness and like daily wealth hacks. I send them every single day. So if you want that for free, you can download the Meet Kevin app, you get my data and all that sort of stuff, and then you can get the daily wealth as well, which I think is cool. But anyway, right now you're seeing the market slip. And so a lot of people are like, why is the market slipping? Well, it's probably because we just had another continuing resolution fail. Donald Trump is talking to Putin because Putin's trying to walk Donald Trump off the cliff of sending tomahawks to Ukraine. I don't think that is like necessarily leading to the market sell-off regarding Putin, though, or sort of a relaxation here. I think people just realize, like, look, earnings for Q3 are good. Taiwan Semi just reported great earnings, but people are starting to use that as an opportunity to profit take. Taiwan Semi literally told us, hey, bros, we thought we were going to have 30% growth in sales next year. We were wrong. Sales growth is actually going to be more like 35%. So we're kicking butt. So ASML's kicking butt, Taiwan Semi's kicking butt. Like, they're all kicking butt. They're doing really well, which is fantastic. So then why are companies selling? Well, part of it is seasonal. October sucks. In fact, Citadel goes as far as saying that October is seasonally bad, but it usually leads to an end of the year rally. So if you get a sell-off in October, it can lead to an end of the year Santa Claus rally. I don't know about you, but I personally have heard about Santa Claus rallies, I feel like every year for the last 5 years, and every time it feels like around Christmas, the market's actually red. Maybe that's just a feeling that I have. Wells Fargo thinks consumers are gonna continue to spend. They they forecast holiday sales rising 3.5% to 4%, year over year. I also, though, I can't help but be skeptical that not only do I think companies are starting to like go into profit-taking mood, where like you could see no news and you could see a stock down substantially. Like, yesterday, I thought this was really interesting. And this is just another example of, just some of the things that we're trying to add to the Meet Kevin app, which I think is really fun. But yesterday, somebody posted, they wrote, hey, there's a dip on Axon. And this is what the Meet Kevin app looks like. And so I posted some screenies. I'm like, no news, kind of weird. And I also said, oh, wow, Axon launched a Mini for healthcare, which is kind of cool. They launched a body camera for the healthcare industry. I'm like, I don't know what that's going to mean for privacy, but people are really excited about a potential healthcare vertical at Axon. It's a great company, by the way. Do I still have my taser here? I gave my taser to Lauren. Darn. I love taking that thing out and showing it off on videos. But anyway, then I posted that this was crazy. This was a crazy headline. I posted that. This is in the community tab, by the way. Course members get the community tab. We're just now building it out. It's like in alpha. But anyway, just keep trying to add more value. But listen to this. China is adding 14 foreign entities to some of its unreliable entity lists. And that includes Dedrone by Axon. So this is actually kind of scary in my opinion. And then by the way, we looked at volume because I was working to align insider sales on Axon, and you could see that on the 24th over here, and then here recently yesterday. But anyway, those are just some of the things I was posting. But Dedrone is a company that Axon bought, and it was designed to fight enemy drones, whether those are military drones, whether those are just like, consumer drones and, some losers doing things they shouldn't be doing with the drone or whatever. And they want to sell these Dedrone products to countries like, whether it's the United States or Germany or whatever to take down these drones. And I think it's very interesting that China is like, oh no, we don't like this. We are a massive drone manufacturer. We are now going to add the company that wants to take down drones to our list of unreliable entities. To me, that's a little bit of a war threat. I didn't like seeing that. I'm like, man, yeah. I mean, think about like the byline you could run with that. I actually wrote it here. China bans American company fighting hostile drones, while China is a massive manufacturer of potentially hostile drones, right? I mean, they manufacture, well, so does Iran. Iran manufactures hostile drones as well, but we know DJI is a massive manufacturer of drones. They're actually really good too, which in part is also scary. But anyway, I think broadly what's going on is you don't have this foregone conclusion that the Federal Reserve freaking out with rate cuts definitely means market up. I think that is like a belief by retail, but it's just, as somebody who studies the Fed on almost a daily basis, I just want to remind you, and this is not to be bearish. I feel like I'm more in like the neutral camp. I'm like, we can teeter either way here. But as somebody who studies the Fed, I just want to remind you, the Fed cutting, especially when they start getting nervous, is a warning sign. I will explain that briefly. But I also want to mention MP Material. Shout out to the Alpha Report, because yesterday in the Meek Kevin Alpha Report, I shouted out that MP Material was likely to reject 100 again and sell down from there, especially as the sort of recent momentum starts fading. Dude, we went to pre-market 104. That's it. Once we rejected 103 times, over. Triple rejection, down. So if you want these sort of insights, make sure you're part of the Meek Kevin Alpha Report. I think it's really good, and it also keeps us level-headed. Like we were talking about, hey, like there's some profit taking coming even this morning. But anyway, and we did fundamental analysis this morning as well. But understand that the Fed cycle, which we could really analyze by just look at FOMC St. Louis Fed rates. Okay, let's look at the FOMC effective Fed funds rate. Okay, so when you look at the effective Fed funds rate, and we look at the business cycle. So let's just zoom in over here. We'll go to the 60s for a moment. You can see that you have to know that recessions are painted in the past. So most people probably didn't know in the 60s that we were in a recession until like August or September of 1960, right? Because these lines get painted in the past, the big gray recession lines. So the Fed was cutting into recession. That's very, very common that the Fed cuts into recession, right? And so let's look a little more granular into some of the recent numbers over here. So we know COVID, obviously. Let's look at 2008. Okay, the Fed started cutting in July of 2007. Okay, we didn't realize we were in a recession until September of 2008 with Lehman Brothers. The Fed had already been in a cutting cycle. The market didn't bottom from cuts. The market bottomed because we turned the money printer on. Every time we run the money printer, that's the bottom. It's not the cuts. Oh, that happened again. That's interesting. I think when I bang on my computer, on my keyboard, that happens. Let me lock that so that stops happening. That's funny. But let's do another one. I think it's a worthwhile experiment. Let's do another one. Let's look at 2000 and the early 90s. Look at this. Early 90s, you cut in 89 going into the 90s crash. You cut going into the dot-com recession, right? Let's do it again. Let's go to the 80s and 70s. So 80s and 70s, you're cutting going in. You're cutting. Now, this was actually interesting because of all the inflation in 74. This was the Arthur Burns era. This is where the Fed lost a lot of credibility. You actually hiked during the recession. Fed was all over the place in the 70s. So this is probably not the best example. And then, of course, we had the Paul Volcker double recession over here. But this was also to fight the inflation disaster of the 70s. So this is a little harder to utilize. But I would say before the 1970s disaster, where they removed price controls, price inflation went crazy. The Fed had to, fix the Arthur Burns mistakes by Paul Volckering and actually putting the pants on at the Fed. Typically, you see rate cuts as an intro to a recessionary environment. And that's not to say we don't want to be bullish. Trust me, I want nothing more to be bullish. I was literally sitting yesterday saying, hey, I don't want a recession to happen because I think the AI that we're going to launch is going to be freaking awesome. And I think we could sell a lot more of it, if there's no recession. Although I think, honestly, we probably do really well during a recession anyway because, well, we have no debt. No bank debt. And, people, there are going to be a lot of deals to go pick up in real estate. So, I guess who knows? Maybe we'll be fine either way. But, it's just bad for a lot of people. And if household wealth gets crushed, man, because of profit taking or whatever, some kind of down cycle, that's going to suck. But look at the consumer stocks. Briefly touched on this earlier. Look at Dave & Buster's, for example. Dave & Buster's is just sort of your classic consumer stock. We're knocking on the door of Liberation Day lows. And if you zoom out even more, we're at almost COVID lows on Dave & Buster's. I mean, not quite. I mean, COVID, we got really low. It's like COVID, post-COVID shock stabilization lows. And then you've got restaurants. They're not doing the best either. I mean, you could see Cheesecake had a nice little rally here, but we're starting to see this slowdown in consumer plays. And it sort of makes some people wonder, like, hey, is this a red flag that, the consumer, while they're hopeful, once these layoffs hit, which now we're starting to see, we're getting these announcements again of thousands of layoffs. That's actually something that's making people nervous too. Is you look, lately, what a lot of the companies have done, like Salesforce, is they've actually just said, hey, everybody's got to come back to the office. And when you fundamentally analyze Salesforce, you see that Salesforce is growing its operating leverage, which basically means their revenues are growing at one pace, but their operating expenses aren't growing as much, which means they're making more money. Their margins are going up. One of the ways they're doing that is they're requiring everybody to go back to the office. But requiring people to go back to the office is basically a way of sort of encouraging layoffs through attrition. So then people leave and they quit their job because they don't want to go back to the office, whatever, and they don't rehire. But the fact that Amazon is now bluntly going, we're laying off 15% of HR, and Nestle's like, we're laying off 16,000. When we get those larger waves of layoffs that we've kind of been insulated from since 2022, we had a lot of layoffs in 2022. If we start seeing those large waves continue, just know the beverage curve, however you want to say it, will normalize very quickly. And that will shoot the unemployment rate up, and then the Fed will have to continue to frantically cut. So, somebody was asking me yesterday, they're like, but Kevin, the Fed's cutting, they're shifting dovish. You said that's what they should be doing. That's bullish, right? And I'm like, yes, that is what the Fed should be doing. But is it bullish because they're doing what they should be doing? Or is it bearish because they're realizing they're too late? So it's like, yes, they should be cutting. But are they cutting because they're too late, or are they cutting because they want to get ahead of it, right? I mean, look at this. United Airlines was talking up their premium revenues yesterday, right? They were literally talking up all of their premium revenues and how great they're doing and how much money they're making. And mind you, when you actually look at their earnings, their capacity was up. So that was one of the reasons their earnings actually went up. Their pricing power actually went down for normal seats. Pricing power went up for expensive seats like premium class tickets. But lower class tickets or normal class tickets actually fell. Like their pricing power is non-existent. The only reason revenue popped is because they added more planes basically. But they actually had decent earnings. People were cheering this company's earnings yesterday. In fact, if you look at the post-market, you could see post-market, they initially ran. United Airlines, yay, the stock's ran. Look at it now. It's tanking. And part of it is probably this fear that, wait a minute, do we need to take profits now? Or are they only going up because they're adding volumes? Are consumers really under pressure here? You've got United Airlines also, by the way, announcing that they're going to shrink headcount by 4% in 2026. United says many competitors lost money during the summer, and United expects to hire pilots and flight attendants in 2026. So it's kind of interesting because they're kind of like, hey, we're going to hire operations staff, but they're probably talking more layoffs in like the human resources side because of AI or otherwise. But again, I mean, they had revenue per passenger mile that beat expectations, and their earnings forecast beat expectations. But the stock's down 9% now. That's huge, even though they beat. And so who knows again? Maybe it's just that seasonal time of the market, where people are like, all right, time to take some tendies. And I get it. Like, I totally get it. Again, I say this just to be like a reasonable person. I don't want to just, shill one argument. But I don't think if you've made good money this year, remember, you're going to have to pay taxes. If you're a trader, you've made good money this year. If you're running a business, you made good money this year. Dude, I got a massive tax bill coming up. Thank you in part to so many of you joining the Meet Kevin Alpha Report. Honestly, I think we're hitting it out of the park with the Alpha Report. Like, people are emailing me going, dude, like Kevin's in this groove we haven't seen in years. And I thought it was really nice. Well, partly I was like, oh, you saying I've been out of my groove a few years ago? Maybe I was. But now they're like, no, now it's on it with the community updates, the videos, the live streams, the Alpha Report, whatever. So I really appreciated that. I thought that was nice. But they're going to have taxes to pay. And so, I'm at that place where I'm just like, I'd rather not gamble my tax money on some of these valuations. because this is a common thing that we do as investors. Like, we know we have a tax bill coming due next year, but then we're like, but just leave it in the market a little bit longer. Just a little bit more, man. Just a little bit more. And you have to remind yourself, that is the definition of greed. And that's like a biblical sin. So, part of me is like, you don't want to sell anything because you want to keep going on the ride. But then on the other hand, it's like, well, what do you want? You want to be safe? So I don't know. It's a balance. I think that's the way to put it. It's a balance. Like, nothing says sell out, but de-risk. Nobody should fault you for nobody should clown you for de-risking, right? That's kind of interesting, and then obviously gold, like the fact that it keeps rocketing is a warning sign, because it could also be indicative of, the economy. Part of it is just momentum, because when it goes up, it just keeps going up. This like 2% again today, dude, for gold, 2% in a day. We're now at 4,300 basically on gold. It is becoming less of a good investment and more of a red flag, because it's exactly what happens leading into recessionary environments. What'll probably end up happening, not yet, but eventually what'll probably end up happening is, I do think the government shutdown will end before the end of the year. My rationale for that is you're going to end up having Democrats that are like, bro, you guys said we would be able to negotiate healthcare subsidies before the end of the year. Now we're at the end of the year. And then they'll have some kind of deal around healthcare subsidies and the end of the year, reopening of the government or whatever. Then you're going to get like 2 or 3 jobs reports all piled into like one day. And people are going to be like, oh my God, we're in a recession. That's a real risk factor, right? Hopefully we confirm a soft landing. But people are going to go, oh my God. Typically, gold sells off once you acknowledge, like, oh my gosh, we're in a recession, and bonds skyrocket. Like, people go from gold, the horde just like stampedes over to bonds, and bond yields tank. And the side where you tend to make the most money in that sort of scenario is the longer end. So the 10, 20, 30-year end of the curve. The shorter end of the curve moves larger, but the actual underlying price movement is very little. Because there's no duration. But anyway, the 10-year is about to break under 4. That's a big moment, because once we get under probably 396, that's when you could get sort of that escape velocity to the downside, upside on bond prices, right? So we'll see, but we are in a wild time of uncertainty, and it's sort of those times where I'm like, it pays to be just safer. And remember, if you want to see what I'm doing, like where I'm putting money or where I'm trimming money, join me in the Meet Kevin Alpha report. You see it all the time. So you get, we were just like 20 minutes ago, I sent out a trade alert, and it's not designed to be copied. It's not personalized financial advice. I can't guarantee I'm perfect. Definitely not. But yeah. That's my take on what's going on in the market.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.